Today, I want to talk about the US market, which is at a turning point. Earnings, we're going to talk about earnings, we're going to talk about trade policy, geopolitics, and the Fed's easing path. So there's a lot to discuss today. So to kick things off, we're going to talk about the Q3 earnings. Okay, how is it so far? Now, the S&P 500 is coming off 3 straight quarters of double digits EPS growth, but momentum appears to be moderating. Now, FactSet data shows Q1 2025 EPS grew a robust 13.6% year over year, followed by 10% growth in Q2. Now, looking ahead, analysts expect mid-single digit gains for the second half, about 7.6% in Q3, blended year over year as of August 2nd, and 7% in Q4. In other words, earning growth is decelerating from the double-digit pace of early 2025. Now, normally analysts lower their earnings forecast in the first month of a quarter by about 0.5 to 1.5%, but this time is different. In July, Wall Street's collective forecast for a company's earnings per share in Q3 estimate actually inch up by 0.1% to 67.40, the first early quarter increase since Q2 2024. Now, this small but unusual uptick hints that Q3 may turn out a bit better than initially expected. Energy and technology saw modest forecast upgrades, while healthcare estimates move lower. Now, to summarize the earnings trajectory and expectations, here is the table right here. Now, this is what I've explained earlier on. As you can see, from double-digit earnings dropping to single digits, and Q4 expectation is at 7%. So overall, earnings pressures are rising. The bar for Q3 is modest, yet any further macro headwinds, example, higher costs from tariffs or slowing demand, could squeeze profits margins with valuations elevated. At 22 times forward PE, the market is vulnerable if earnings disappoint. So the earnings has to surprise, be on top of the expectations every single quarter. If not, with the current valuations, you might see a bigger correction. Now, for the Fed outlook, now we are seeing dovish shifts on rate cuts. The July jobs report delivered a major surprise with only 73,000 jobs added versus about 110,000 expected, alongside a 258,000 downward revision to May-June payrolls. Now, this erased 2 months of job growth and raised concerns over labor market strength. Now, wages slowing, temporary hiring is weak, and signs point to a faster than expected loosening in employment conditions. Market now price a 90 to 95% chance of a 25 basis point cut in September and about 62 basis points of easing by year end, implying 2 to 3 cuts. Now, by early 2026, policy rates could drop towards 4% or lower. Fed officials have not resisted these expectations, with 2 governors voting for immediate cuts in July and Chair Powell signaling readiness to respond to labor weakness. Now, the scale for labor markets revision has cast doubts on earlier strong job gains. While some point to data collection issues or seasonal adjustments quirks, most economists say the process remains non-partisan. Still, the episode is likely to make investors more cautious with initial job reports. The softening labor trend combined with the sharp payroll revision suggests that economy may be on shakier grounds than thought. So with regards to the rate cuts, the Fed's likely to move into an easing cycle, mirror past late cycle downturns responses, rather than mid-cycle insurance cuts. Historically, such pivots helps market over time, but often follow periods of earning pressure. Now, in the short term, expectations of cuts have lifted sentiment, with gold prices hitting 2 weeks high and treasury yields falling. It suggests that the context is the cuts are coming because growth is faltering, not because of inflation is fully tamed. Now, with regards to the data credibility, because of this huge, what I call revisions, the BLS revision has sparked debate over data reliability, particularly after President Trump's firing of the BLS commissioner. Now, while large revisions can occur under standard procedures, the unusual scale means investors may treat early labor reports with more skepticism. A negative 90% for May-June jobs gain revision is indeed shocking. Okay? Now, as for the market impact and outlook, bond yields and the dollar have both dropped as investors position for a weaker US economy and easier monetary policy. Now, with 3 cuts penciled in, the Fed is preparing to cushion a slowdown, but whether the shift comes quickly and forcefully enough to avoid a hard landing remains uncertain. Okay, so for the tariffs and trades, on August 12th, which is tomorrow, the pause in US-China tariff is set to expire, risking a snapback to punitive levels of about 80% on many goods unless extended. Now, this would strain supply chains and could reignite inflation, especially in sectors like technology, electronics, and apparels. Beyond China, tensions have spread to other key partners. In early August, President Trump doubled tariffs on Indian imports to 50%, citing India's continued purchase of Russian oil. This raises the risk of tit-for-tat retaliation. Now, this move will raise costs for US importers of pharmaceuticals, textiles, and other goods, while setting a precedent for using trade measures to enforce geopolitical objectives, thus adding uncertainty for multinational companies. Now, meanwhile, Canada and Mexico, America's largest trading partners, remain largely tariff-free under USMCA, but targeted duties of 25 to 35% are being considered on certain goods if talks stall. Now, while most trade will still be exempt, even limited tariffs could disrupt industries such as autos, dairy, steel, and energy. Higher tariffs act as a tax on US businesses and consumers, pushing up costs, pressuring margins, and risking a stagflationary mix of slower growth and high inflation. Sectors heavily reliant on global supply chains like technology, autos, and industrials face the greatest risk, while domestic-focused industries may hold up better. Additional threats include retaliatory tariffs, supply chain rerouting expenses, and weaker business confidence, all of which could weigh on 2025 earnings. And there's also a surprise announcement by Trump. Okay, he has indicated in the past he's going to tackle this issue, and tackle he did. So that is a semiconductor tariff threat and capital expenditure boom that follows this semiconductor tariff announcement. Now, Trump has threatened 100% tariffs on imported semiconductors, including chips from Taiwan, unless production is expanded significantly in the US. Now, while the measures has been delayed, the threat is being used as a leverage to force onshoring of critical chip manufacturing. Now, this alone has triggered an unprecedented capital spending surge in the semiconductor and tech industry. Apple, for example, pledged an additional 100 billion to expand its US silicon ecosystem, bringing total planned US investments to 600 billion, aiming to avoid a possible 25% tariff on the iPhone. Now, TSMC, on the other hand, is accelerating its Arizona fab projects, adding 100 billion to reach 165 billion in total US spending, and moving completion forward by 6 months to produce advanced 3nm and 2nm chips domestically. Nvidia supports the push, but warns tariff could raise costs until US capacity comes online. They need that, okay? Global Foundries announced a 16 billion expansion on New York and Vermont, and Texas Instruments committed 60 billion to build or expand 7 semicon fabs in Texas and Utah, the largest US chip manufacturing pledge in history. So in total, these commitments amount to hundreds of billions in US high-tech manufacturing investments, potentially reshaping supply chains and reducing reliance on geopolitically risky sources. However, in the near term, such massive capex could pressure earnings, free cash flow, and valuations as returns will take years to materialize. Now, higher costs from both tariffs and domestic duplication of supply chains may weigh on margins, and execution risks in building advanced fab remain high. While a long-term positive for US industrial capacity, the short-term impact could be a drag on tech sector performance. Okay. Next is the geopolitical outlook. On the Ukraine war front, Trump is intensifying efforts to end the Russian-Ukraine war, signaling readiness to meet Putin and Zelensky, with a possible Putin meeting as soon as mid-August. Now, he has set an August 8th deadline, which has came and passed. So, but anyway, he has said that he's going to meet Putin. That's a good thing because he wants to push for a peace framework or face new secondary sanctions uh, targeting countries like China and India that continues trade with Moscow. Now, recent envoy talks in Moscow were described as useful and constructive, and Russia has indicated interest in negotiations. Now, ceasefire could lower energy prices by reducing war-related supply risks, boost European equities by cutting energy costs, and reopen Black Sea grain exports, easing food inflation in emerging markets. Now, while US markets might see limited direct gains, reduced inflationary pressures and improved global sentiment could be supportive. As for the Gaza, the Israel-Hamas conflict may also be nearing a turning point. In late July, the Arab League, along with Qatar, Saudi Arabia, Egypt, Jordan, and the European Union, jointly urged Hamas to disarm and cede control of Gaza to the Palestinian Authority, the first unified Arab stance against Hamas. Now, Hamas has publicly rejected surrender but may consider stepping aside for a unity or technocratic government if conditions are met. Israel insists Hamas must be disarmed and removed from governance. Now, resolution backed by Arab states withholding financial support from Hamas could lower oil's geopolitical risk premium by reducing fears of a broader Middle East war. It would also stabilize Israel, Gulf, and Egyptian markets and open the door to large-scale reconstruction in Gaza. As for the market implication of the war, a simultaneous easing of Ukraine and Gaza conflicts would remove two major geopolitical risks with the most immediate effect on energy markets. Now, peace could trigger a sustained decline in crude oil prices, easing global inflation pressure, supporting bonds, and benefiting fuel-sensitive sectors like airlines, transport, and consumer discretionary. Now, emerging markets reliant on energy imports such as India and Turkey would also gain, while both peace paths are uncertain and may yield only partial resolutions. Any significant de-escalation would be a clear positive for global market stability after years of conflict-driven volatility. Emerging markets reliant, on this. This is something that the emerging markets, right, they need to work on. If if this really falls into it, India and Turkey would gain, especially if Trump, gives a lot of pressure to India with regards of buying oil from Moscow, right? Now, for the monetary policy, the QT versus QE, right? Now, the question is QT nearing the end? Because this is very, very crucial for those who are investing in the US market, in the gold, the metals, as well as Forex. Now, the Fed's balance sheet has fallen from 9 trillion peak to about 6.7 trillion as of mid-2025, with QT running since summer 2022 through monthly runoffs of up to 95 billion in treasuries and mortgage-backed securities. Now, bank reserve have declined from 4 trillion to 3.3 trillion, and reserve repo usage has plunged, signaling tighter liquidity. Market expects QT to end by early 2026, near a 6.2 trillion balance sheet, the levels where reserves are deemed minimally ample. Now, Fed officials want to avoid shrinking past the point where reserves become scarce and have slowed QT before to avoid market stress. QT could end sooner if economic or credit conditions weaken, but once it stops, the Fed is likely to hold the balance sheet steady before considering expansion. And when could QE return? QE is historically deployed when rates are near zero and further stimulus is needed, as in 2008, 2009, and 2020, with current rates projected to remain around 3.75 to 4% after expected cuts. A return to QE is unlikely unless a deep recession or severe financial crisis occurs. Okay? Now, overall conclusion, you need to understand this. The balance of forces remains tilted towards near-term economic headwinds, probably in 2026. Earnings growth is slowing, the labor market is weakening, and tariff risk could reintroduce inflationary pressures while hurting margins. If 2026 continue to see earnings slowing down as tariffs begin to take effect, the stock markets would see more stress. Monetary policy is shifting towards easing, but the Fed is still far from deploying QE, and QT continues to drain liquidity. So if the Fed cuts rate in September, November, and December 2025, the US stock market could see a short-term lift as financial conditions ease and investor sentiment improves. However, with rates still far from zero, the policy stance would remain restrictive by historical easing standards. So if tariffs-induced inflation takes hold during this period, it could offset the benefits of rate cuts and lead to renewed economic stress. On top of that, if Fed do cut rates to the 0 to 1% range next year, it would likely signal that US economic conditions have deteriorated significantly, prompting emergency level monetary easing, which is not good as well. Okay? Because you cut rate too fast is not a good thing. Fiscal stimulus via one big beautiful bill could improve a temporary boost, but is not yet enacted and may come with long-term debt implications because this is a spending bill. Okay? Finally, geopolitical developments are the largest potential positive catalyst. If both conflicts de-escalate, the resulting drop in energy prices and risk premiums could meaningfully improve the global growth outlook. Okay, so with that, hopefully you have a better understanding of the overall situation, and that's a report for today.